We are definitely heading into a period of high inflation. The signs are all there. The last time we saw house prices grow in such a dramatic fashion was back in 1988, when inflation was at 7.33%. If you have been keeping track of the everyday goods that we buy, such as housing, petrol, cars, groceries, the cost of them have all gone up dramatically in the last 12 months. If you're looking to build a house, the cost of building materials and labor have also gone through the roof. And this will make perfect sense because our central bank and the central banks around the world have all been printing money like there is no tomorrow. Whether you like it or not, this is going to lead to inflation, and we are starting to see the signs of that inflation. So far, most of this inflation has been absorbed by assets such as stocks and real estate, but this is starting to flow more and more into everyday goods that we require to maintain our quality of life. In today's video, we'll be talking about what this means for our hard-earned money, how we can protect our purchasing power, and how I personally plan on profiting from this devaluation of our currency. As always, this is not financial advice and I am not a financial advisor. I'm simply sharing with you my personal opinion. And I will always encourage you to do your own research and due diligence and seek the help of real financial experts. And without further ado, let's get straight into the video. Inflation is a word that gets thrown around quite often, and most of the time we don't even know it exists because it increases the price of our everyday goods and services so slowly that we barely even notice it. However, that's only the case if inflation is maintained at a healthy 2%, which is perfect for economic growth. And that's what our central banks and the central banks around the world aim for. But what we can agree on was that 2020 was a very special year. After the stock market crash that we saw around the world, the governments had to step in to stop their economies from collapsing. And what was their solution? Well, it was very simple for them. All they had to do was print more money and inject it into our economy in the form of stimulus. And as a result, the central banks around the world printed trillions of dollars and injected it into our economies. Whenever there is a large increase in the money supply, the money has to go somewhere. So far, most of that money has gone into the stock market, the real estate market, cryptocurrency, collectibles, and NFTs, which is a digital collectible. However, these assets can only absorb inflation for so long before it flows into our everyday goods and services. To make sense of all of this, let's use an example. A real estate investor who purchased a property 2 years ago is seeing significant growth in his investment, and as a result, he feels very wealthy. Because he's feeling wealthy, he's going to spend more money. And what's he going to spend the money on? He's going to spend money on a new car, maybe a new house, maybe a fine dining experience with his wife, and eating out more often, which is really good for the economy. However, when this happens on a mass scale, when the other property investors and other stock market investors who are all feeling more wealthy as a result of this inflation and appreciation of the investment, they are going to go out and spend money as well, which increases the demand for these goods and services, which in turn will drive up the prices. If you are in doubt about the level of inflation that is happening in our economies, then I want you to start tracking your everyday spending. How much you spend on groceries, food, petrol, and all the other goods necessary to maintain our quality of life. And over a period of time, you are going to notice that the price of these goods have gone up significantly. When the property data for March was released, it showed our housing market growing at the fastest rate in 32 years. Most people think this is simply due to a growth cycle, but I disagree. I believe inflation has a strong role in this as well, because inflation increases the price of everything, including real estate. Because the last time we saw this kind of growth was back in 1988, where reported inflation was at 7.33%. And that's reported inflation. The real inflation is usually much higher than the governments and central banks are willing to admit. So if we are indeed heading into a period of high inflation, what does this mean for our hard-earned money? Well, the simple answer here is that the money that we have been working so hard for is losing its value every single day. And our purchasing power is decreasing every single day and faster than we can imagine. And we can only buy a fraction of what we could have bought if we spent our money a few months ago. Think about it, what kind of car could you have purchased with $20,000 this time last year? And what kind of house could you have purchased with $500,000 this time last year? During a period of high inflation, savers really are the losers here, because their money is being devalued at such a rate by the end of this high inflation period, it could lose half of its purchasing power. To me, this is much more scary than any market crash that may or may not happen in the coming months or years. As the investing tycoon Peter Lynch said, far more money has been lost by investors preparing for corrections or trying to anticipate corrections than has been lost in corrections themselves. He's of course referring to the opportunity cost of sitting on the sidelines while your money gets eroded away by inflation. The same opportunity cost that has now priced out many would-be homeowners who have been sitting on the sidelines waiting for a market crash. I do not disagree that we are currently under some very dangerous economic conditions, and our economy is more fragile than our governments are willing to admit. And we could very well see a correction in the coming months or years. However, I'm not willing to bet against our government and the Reserve Bank of Australia just yet, because of how much a property market means to the Australian economy. Based on how much the property market means to the Australian economy and taxation, the government is going to throw everything at it before letting it crash. As discussed in my previous videos, the Australian government and the Reserve Bank of Australia can't afford to let the property market crash because of the devastation that it will bring to our economy and Australian households. And this has been proven again and again. Back in 2008, when the government introduced various stimulus measures and the Reserve Bank of Australia aggressively lowered interest rates to bring confidence back into the market. And once again back in 2020 when we started our lockdowns. So what does all of this mean? Well, I believe this means that if we bet against the housing market, we are not only betting against our government and the central bank, we are also betting against inflation. As a long-term investor, I always ask myself two questions before investing anything. The first question is, am I going to be able to afford the repayments on this investment when the interest rates go back up to the long-term average of 6%? And the second question is very simple. Is this investment going to be worth a hell of a lot more in 20 or 30 years' time? If the answer for both questions is yes, then I have no issues buying and holding on to this investment. And any short-term correction will simply be a small dip in a long-term uptrend that is going to make me a lot of money. So now that we know inflation is here and that it's going to eat away at our purchasing power over a period of time, and high inflation is going to accelerate that process, then it is very important for us to protect our money and our purchasing power. But the question is, how do we do this? When asked about this period of high inflation that we're about to enter into, and what we should do to protect ourselves during this inflationary period, billionaire fund manager Ray Dalio simply said to go out and buy stuff. Any stuff that will equal inflation or better. He then went on to suggest that it might even be a good time to borrow money to buy non-debt, high-returning investment assets. He then went on to say that cash will continue to be trash and that assets in mature, developed, reserve currency countries will underperform the Asian emerging markets, which includes China. There are a lot of technical terms here and sounds pretty damn confusing, but reading between the lines here, it seems like Ray is suggesting that the US and its many asset markets will struggle in the coming years, and that the Asian markets could be a better investment. So what does non-debt, higher returning investment assets mean? Well, believe it or not, in the modern world, almost everything is attached to debt. Raw materials like soy, oil, and lumber are all traded on the futures market. And in these markets, they use a massive amount of leverage. In the current globalized world, I'll assume Ray means assets that are decentralized and not attached to debt, so we can hold on to it for a long period of time. The things that come to mind are gold, silver, and cryptocurrency. Now, this is where me and Ray do not agree. I personally think real estate is not only a great way to protect our purchasing power, but also a great way to profit from inflation. Real estate is something that we can touch, something that produces an income, and something that has grown with inflation for the last 100 years. Ray even said it himself, we should buy income-producing assets that will beat inflation and borrow money to buy these assets. Real estate is an asset that has been beating inflation for the last 100 years, and the debt and mortgage that I'm about to take on will be inflated away to a fraction of what it is now. While it is not impossible to see a correction in housing markets, as mentioned before, any correction in the short term will simply be a small dip in a long-term uptrend that is going to make me a lot of money, provided that we are able to hold on to and service this asset for a long period of time. I know what some of you guys are thinking. Am I not worried about how over-leveraged our property markets are and people's ability to make repayments when interest rates do start rising? Yes, I am. That's why I'm staying away from the highly leveraged markets of Melbourne and Sydney, but instead focus on markets where I can find rental returns of 6 or 7%, which means I'll have no issues of holding on to this property, even when the interest rate goes back to the long-term average of 6%. I did a video on affordability and debt serviceability last week, where we talked about how buyers in Sydney are already stretching themselves to the max to enter into the property market, while markets like Perth have no affordability issues. And markets like this is where I'll be putting my money. Now, this is not financial advice, but my personal strategy to protect my purchasing power and profit from inflation is to buy and hold a diversified portfolio of real estate, gold, silver, and cryptocurrency. And the most important part of this strategy is to lock in the interest rate for as long as possible, because we know that the interest rate is likely to rise sooner than expected. This is my personal strategy, but I would like to know in the comment section below, how are you preparing for this period of high inflation? Alright, this brings us to the end of the video. I want to thank you guys for watching to the very end. If you got value from this video, please do me a huge favor by hitting that like and subscribe button right there. And I will see all of you guys in the next video.